I'm going to walk you through commercial loans in the UK, what they are, why businesses use them, the different types that are available, and what you need to look out for if you're thinking about applying. By the end, you'll have a clear idea of how these loans work, the pitfalls to avoid, and how to make the right decision for your business. So let's start simple. A commercial loan is money borrowed by a business to help fund the growth, expansion, or day-to-day operations. As a way of an example, let's say a cafe might take out a loan to refurbish its seating area and kitchen. A construction company might need one to purchase heavy machinery, or let's say a property investor might use a commercial mortgage to buy a block of offices. The key difference compared to personal loan is that commercial loans are tailored to businesses, and that means repayment terms, interest rates, and eligibility criteria are very, very different, okay? And think of it as the financial backbone that allows businesses to push forward instead of standing still. Businesses borrow for all sorts of reasons. Some of the most common are growth, opening of new sites, hiring staff, scaling operations. You've also got cash flow, bridging the gap when money going out doesn't quite match the money that's coming in. You've also got assets, buying of equipment, vehicles, or property. Then there's working capital, covering everyday expenses during quieter periods. And here's something that's really important, okay? Borrowing isn't always a sign of financial weakness. More often than not, it's a strategic move. Some of the biggest and most successful companies borrow regularly because it helps them move faster than relying on savings alone. Now let's dive into the type of loans that are available. You've got term loans. This is where you borrow a lump sum, pay it back over an agreed time with interest, okay? This is great for bigger investments like new machinery or refurbishments. An example of this, okay, could be, let's say there's a gym owner out there that takes out a 5-year loan to install new equipment and expand their studio space. Then you've got short-term loans. This is usually under 12 months and designed for urgent cash flow or seasonal fluctuations. An example of this, okay, could be, let's say there's a retailer out there that's gearing up for the festive period, orders stock in bulk and needs a short-term loan to cover that upfront costs. Then you've got commercial mortgages. These are loans to buy or refinance commercial property, okay? And typically, okay, you will need a deposit between 25 and 40%, and terms can stretch up to 25 years. And interest rates are usually higher than residential mortgage because lenders see more risk attached to commercial property. An example of this could be a business owner buys their own premises rather than paying rent. You've also got secured loans, and this is backed by an asset, often property or stock, okay? And the benefit is lower interest rates and bigger borrowing amounts, but there is a risk attached. If you default, the lender can repossess the asset, okay? An example could be a manufacturer secures a loan against their warehouse to fund new machinery. You've also got unsecured loans. No collateral needed. This is good for businesses without big assets, but higher rates and stricter checks. An example could be a digital marketing agency with strong cash flow gets an unsecured loan to fund a new client project. Then there's also stock or inventory-based loans, and this is where they borrow against the value of your stock. This is useful if you're product heavy and need liquidity, okay? An example could be a wholesaler uses inventory as security to access short-term funding. So each type of loan has its own pros and cons. The trick is knowing which fits your business best. Let's talk about eligibility. Lenders will assess a few key things, okay? They'll look at your business age. Startups usually face tighter restrictions. They'll also look at credit history, both business and sometimes personal. They'll want to see financial performance. Lenders want to see consistent revenue and profit, okay? They'll want to see a detailed business plan. Do you have a clear plan for how you use the loan and pay it back? They'll want to see documents like your accounts, tax returns, forecasts, and ID for directors. Here's the reality, okay? Lenders aren't just lending to your business, they're lending to you. They want confidence you're credible, reliable, and capable of running the business well enough to pay them back. Now let's take a little look at how repayments work. You've got fixed interest rates. These are predictable monthly payments that are good for budgeting. You've also got variable rates. These can go up and down depending on the market. There's also repayment holidays. Some lenders let you pause capital repayments for a few months or even years at the start. There's also interest only periods, and you pay just the interest for a while, then move on to full repayment terms later. An example of this, okay, could be, let's say there's a hotel business that might use an interest only period while refurbishing, knowing that full revenue will only kick in once they reopen. But let me say a word of caution: repayment holidays and interest only periods don't make the loan cheaper. They just delay the heavy lifting, okay? This is a big one that catches people out, okay? So loans aren't just about interest rate. There are often extra costs associated. You've got arrangement fees, and these are usually between 0.5 and 5% of the loan. There's also security fees. These are covering legal or valuation work if an asset is involved. Then there's lending fees. These are admin and processing. You've also got prepayment fees. These are charges if you pay off the loan early. I'd say always factor these in, because a loan that looks cheap on the surface can actually end up being more expensive once fees are added, okay? So who actually lends the money? You've got high street banks. These are stable, competitive rates, but often slower and stricter. You've also got alternative lenders. These are quicker decision makers, more flexible criteria, but often higher rates. Then you've also got specialist lenders. These are tailored to certain industries like agricultural, property, or healthcare. Each has their own pros and cons. The key is matching your needs to the right lender, okay? So to wrap up, commercial loans are a powerful tool for growth, but only if you choose the right type and structure for your business. Always do your homework. Know your numbers, understand the repayment terms, and compare different providers. And don't forget about the fees and charges because they can change the true cost of a loan. If you like support in finding the right loan or want someone to do the heavy lifting and compare the market for you, get in touch. I'd be happy to help.